and welcome to this FTI Treasury Talks, where we're going to be looking at some of the strategies and processes that could be used for foreign exchange risk management within an in-house banking structure. My name is Justin Callaghan, and I'm the CEO here at FTI Treasury, and I'm delighted to be joined today by Eileen Murray, who is a senior manager in our front office trading team, and Shane O'Keefe, who is our head of innovation. Managing the impact of movements in foreign exchange rates on reported results is obviously one of the key economic risks that needs to be managed by the Treasury Department. Centralizing this in an in-house banking structure makes a lot of sense. Here at FTI Treasury, we manage in-house banking structures on behalf of a range of multinational companies. We manage daily processes such as cash and liquidity management, cash forecasting, intercompany loan, intercompany netting, and foreign exchange management. This gives us a bit of a unique insight as to how these things can be deployed well within an in-house banking structure, and we hope to share some of that with you today. So guys, just to kick off at a fairly high level, generally speaking, do you see foreign exchange management as forming part of the remit of an in-house banking structure?
Yes, we do. Yeah. Main reason being is I suppose we have everything consolidated in a one fixed area, and it's easy to kind of see the full picture within that in-house banking structure rather than having everything separated out from it.
Yeah.
So yeah.
And Shane, is visibility of information a big part of that?
Yeah, because from what the in-house bank does, it will have a lot of that, your FX risks already figures in there, because they'll be managing the intercompany loans and all that. So they'll be converting excess cash into more your base currency for if you want to use it. So they have all that kind of remit already, and then just to add in the extra bits of your other FX risk management processes is easy to layer on top of that, because you have the base information and then you're just supplementing more information on top of that.
And tell me, what are some of the advantages of housing your FX risk management approach within the in-house banking structure?
Because if it's all centralized and you're more than likely going to be using a trading platform, either 360T or FXall, because everything's centralized, you're going to get better pricing from your banks. You're able to,
eliminate, I suppose, the number of FX so you need.
Yeah.
And
make the process a lot more leaner. That everything is made sure that it's controlled within your policies and parameters. While if it's a bit more decentralized, you have to have, everybody in the whole organization has to be up to speed on the policy of how it should be done. So it makes sense, and all the expertise is usually within the in-house bank, or your treasury, So
process control.
Yep.
Expertise.
And then benefit of cost.
Yeah, very interesting. And tell me then, so when we do see these sort of strategies being rolled out, generally speaking, are we looking at balance sheet hedging, cash flow hedging, or sort of a hybrid?
Because the in-house bank is hedging the balance sheet of itself already, so you'll have that part in a way, and then a lot of the subsidiaries will be giving us other requests as well. And the cash flow hedging then, if you have your cash forecasting, is easy set up already. It's easy to supplement that onto your thing, so it makes it easier to have a hybrid approach.
Yeah.
And that's the way most of our clients have it at the moment.
So probably nearly everybody will be hedging their treasury transactions, right? From the in-house bank. So intercompany loans, some net inflows and stuff like that.
Yeah.
And then the additional elements of balance sheet need to be found, right? If you're taking that approach. And then cash flow hedging is probably another step, right? Because it's a different type of data. Like maybe just kind of digging into that a little bit, guys. Like from a balance sheet approach, what are the sources and types of data that are required in order to effectively roll out this within the in-house banking structure?
So you need a connection really to your, for the balance sheet hedging, it's, your accounting system, usually SAP or Oracle or one of those, where you will get the balance sheet of all the subsidiaries and they're in the currency balance sheets sent to hopefully an FX risk management system, which will then combine all them into your necessary positions for each subsidiary or on a group basis, depending if you're doing it on a back-to-back or a consolidated basis.
Yeah.
So it sounds that it's easy, but there's, depending on your setup, there could be multiple different versions of SAP or Oracle. So, there's a little bit of setup to it, but once it's done, it's pretty straightforward. And then you can you'll have your treasury kind of information as well feeding into that as well to supplement their balance sheet with what's already hedged, and they mightn't have the current intercompany loan position within their accounting system, depending how often they keep that refreshed. So you can kind of keep that up to date as well from the treasury system.
So key integrations are ERP, APA, or any of the sort of outstanding balances including intercompany.
Yep.
And then on the lending side, you mentioned a specialist system. That helped a lot, right? Because obviously a lot of people lean heavily on spreadsheets, but very difficult to get accurate information, very difficult to track how well you're actually doing it. I think would that be right?
Yeah, like spreadsheets are great. They can give you a lot of flexibility in that, but if a spreadsheet goes wrong, it's very hard to dig into a spreadsheet to find out what is wrong. So I would be suggesting that it's probably it makes the process a lot more foolproof if you have a dedicated system for it.
Makes economic sense probably as well, the long run, right? Just due to resources.
Yeah. And like if whoever creates that spreadsheet ever leaves, it's whoever takes over will spend like 6 months just trying to figure it out. So,
So I mean, we talked there predominantly about balance sheet hedging. What about cash flow hedging? What are the sources of data and how in terms of?
Ideally you have your cash forecast, which we've discussed in a previous conversation, set up, and that will make that easier because you can just then integrate your cash forecasting system into the FX risk management system. But some people mightn't have that. So again, like it's APAR, then you'll have more of a, that will give you like 6 months of what your cash flows are supposed to be expected. Then you'll have to create the next, let's say 12 months based off what contracts you have and how you, what's contracted to flow over the next.
And it's generally speaking is a kind of a 12-month rolling hedge horizon. Is that sort of what you see?
For our clients, it ranges from 12 months to 18 months is the normal, is what we usually see.
And Eileen, in terms of balance sheet hedging, is that like how often are people rolling those hedges? Is it like monthly?
So yeah, it would be monthly. So yeah, because it gives them kind of more control over the changing positions because they are changing quite frequently. So by rolling on a monthly basis, they can reconfigure their position. Yeah, more frequently.
So we've talked there about kind of when you have a consolidated position from a treasury perspective, which is ideal and what probably are striving to get to. But when you're actually hedging exposures which lie on an operating entity's balance sheet or an operating entity's profit flow, like generally speaking, do you see clients hedging on a back-to-back basis? Putting in place an internal hedge, or are they doing it just on a consolidated basis and hoping that the FX noise will consolidate out on the consolidation of the results?
Well, I would see it there's both approaches. So depending again on the company and what they want to do, but we can see like we have one particular company that likes to do it on an entity by entity basis, and that just gives them extra clarity. They want to know where the FX originated from, who's coming from, and then I suppose that gives them further clarity on their cash flow forecasting hedging. And then we do see the consolidated basis where they're happy to put everything in together, get their position, compete that one position out with the bank, the panel of banks, and get the best price on that.
And there's probably a hybrid, right, where you get the consolidated net benefit of the FX trading, but you actually then issue individual back-to-back.
Exactly, yes. So every individual entity will still get their hedge on their books.
On their books.
Whereas on the consolidated basis, obviously, we're only...
That's where the system really comes into play. Being able to identify those numbers and redistribute them effectively amongst the operating entities. We obviously manage intercompany netting processes and cycles on behalf of a whole range of clients, and there's a lot of FX activity that goes through them. How important or how beneficial is it to have an intercompany netting process from an FX perspective specifically?
It's vital. It makes life an awful lot easier if you're clearing out that intercompany FX, on a regular basis. So all of our clients nearly most of them have at least two netting cycles. One maybe mid-month and another one just before month end to get as much of that FX noise out of the way straight away. Another one of our clients does it, like, I think is it every 5 days, just to clear that FX noise out on a regular basis.
They're actually using it as an FX management tool.
Yeah.
Interesting.
And it's very effective, and like intercompany netting, it has it has advantages everywhere for the thing, so it's an easy sell for everybody. So
Not to mention, I suppose, the substantial savings on, consolidating those FX positions.
So, folks, final question, and it's a simple one. If you were starting from the beginning, what one kind of piece of advice would you give a client who wanted to go about, housing an FX management program within their in-house bank?
I suppose I would say you need, obviously, the expertise are very important, and the systems in place that bring all that information together. And I suppose to centralise it, that's really the key for me. If anything is centralised, it gives you the visibility over the whole picture, full picture.
Which is why the in-house bank is an ideal place to kind of...
Essentially. Yes, it gives everyone that visibility. Yeah.
Shane?
I think Eileen has covered it all there, really. But it's, but I would just go with getting a system to do it. It just makes the process that, it's streamlined, and it's, foolproof then for the future, and it just makes everybody's life easier.
Thanks, folks. Very interesting insight. A brief chat, but there's obviously a lot that goes on underneath that. Thank you very much for watching in today to see how we got on here and when we were talking about housing foreign exchange risk management within an in-house banking structure. I think, as you heard from the guys here who are at the coalface of managing this on a day-to-day basis, there's massive advantages to be got from centralising this process. And indeed from leveraging off different systems and systems interfaces. This is something that we do here at FTI Treasury day in, day out on behalf of clients, and if you'd like to discuss that further with us, we'd be grateful for the opportunity. There's loads of information on our website, so please just hop over there to www.ftitreasury.com, and we hope to talk to you soon. Thanks again.